Welcome to Let's Talk Property, an informal podcast show all about the UK property and mortgage market. I'm Nizam, and as always, joining me is my co-host, Lee. Whether you're a seasoned property investor or just starting to think about buying your first home, this podcast is for you. We'll be discussing a range of topics, including the latest market trends, tips for finding the perfect property, and how to secure a mortgage deal. So join us as we explore the world of property and help you make informed decisions about your next property purchase. Lee, you're going to take today's topic, I think, hopefully.
Yes. Yeah, absolutely. Yes, so first-time buyers with parents on the mortgage. So I thought, do you know what? We do so much of this, both of us, I think, and and there's quite a lot out there. But I don't know how many people know about it. And I thought, well, I'd share something. It's a massive, it's a big help and a big step on getting on the property ladder. So there's lots of big benefits to this, and I don't think many people know about it. So I think I don't want to delve into it straight away, but the reason I kind of wanted to talk about it today is because really we do help so many people get on the property ladder with the help from their parents, but not around the deposit. You know, it's not about parents providing the deposit. It's about maybe using their income to support their mortgage application. So I really wanted to hone in on that and explain kind of what specific option is available for first-time buyers.
Fantastic. Great. I think you're right. I think it's something that a lot of people don't tend to know about very well, or don't understand the options, or probably haven't heard of it at all, or why it exists. But there's some really good benefits to it. And I think, yeah, exactly. One of the biggest problems at the minute, house prices are out of reach for a lot of people. Getting on the property ladder for the first time doesn't just mean deposit's difficult, but also means getting the mortgage amount you need to borrow is really, really difficult because you have to evidence affordability. So I always say the only way to increase your mortgage borrowing is to add more income. And if you can add a parent on or two parents on, then yeah, absolutely. You've got more income there you can use to get a bigger mortgage. So really good solution. But yeah, I think it will be a good one to sort of explain.
Yeah, absolutely. I'll jump straight into what it is. So it's formerly known as a guarantor mortgage. So you'll probably see that a lot, and you'll probably hear that maybe from your parents. You know, I think it's the mortgage is used to be called a guarantor mortgage. It's now even more of a mouthful. It's a joint borrower sole proprietor. I love that. So joint borrower sole proprietor. And effectively, it means there can be multiple borrowers, so one or two or three, maybe even more. So there can be multiple borrowers, but one single owner. So one single owner on the property is effectively what that means. What are the benefits to doing that? So obviously, you can name your parent on the mortgage with you. So if they're already named on their own property, you can name your parent on the mortgage to support your application. So you can use their income to boost your borrowing. So if you're buying on your own and you can't quite get the borrowing you need, you're really struggling based on the level of income, then you can use your parents' income to support your application. So as you can imagine, your income is assessed. You know, your income and outgoings is assessed and scrutinized, I suppose, as well as your credit history. And so is your parents, because they are a borrower and named on the mortgage as well. So their outgoings are assessed. So if they've got a mortgage, that will need to be taken into consideration. If they've got their own home and they've got sort of bills and commitments as well, again, that will need to be taken into account. But it's a fantastic way of getting the borrowing you need, and getting you to the sort of level to reach, as you say, as property prices increase, getting you to that, maybe plugging that gap to what you need. So yes, it's a specialist mortgage. So not all banks do it. To be honest, there's a few. Some high street banks do offer joint borrower sole proprietor mortgages. There is very few, but it is specialist mortgage advice. So you know, it's not. I would say it's probably more. You'd probably need sort of a mortgage broker or you know, a mortgage advisor more specifically, who knows about joint borrower sole proprietor and has done it and dealt with it before and has experience in the area, to get a mortgage on joint borrower sole proprietor.
So what's the difference between, because what a lot of people I think will have the question of is, what's the difference between a joint borrower sole proprietor and just adding your parents to a mortgage? Because surely any mortgage lender will allow you to add a parent to it. So what's different between doing that and a specific joint borrower sole proprietor mortgage?
Yeah, so I guess it's your home. You own it singularly, so it's not owned by your parents. Your parents are responsible for the mortgage, like you are, very similar. I think that's very clear. But the big benefit is obviously it's your property. But also if you were to buy a property with your parents and they were named on the mortgage and the property, in theory you're not then classed as a first-time buyer, and there could be some stamp duty, liabilities, and it does have its sort of complications in terms of I don't want to delve too much into tax, but it does have its complications in regards to tax as well. So the huge benefit is the property is yours. It's singly yours. You own the property, and when it comes to remortgaging or in future, it would just be a case of taking that person off the mortgage, and when you can afford to take it on your own, and remove them from the mortgage, and then at some point carry on a new mortgage singularly. So I think that the big benefit is you could just go and buy a property with your parents named on the mortgage and named on the property as well. But again, there are some added complications, more specifically around tax as well. And the long-term benefits, it's a lot better for you to be single owner, particularly if you want to, particularly if you can afford to be named on the property on your own in future. And that is the kind of purpose of those sort of schemes is, or the mortgage specifically, is they see them as short term, sort of 2 years, 5 years, maybe even up to 10 years, not the full mortgage term. Not talking 20, 30 years. Your parents not going to be supporting you for that period. So these mortgages are designed for short term fixes until you're at a point where the mortgages come down, you can afford it, and your salary's hopefully gone up, so you can afford it on your own.
Yeah, I think, and again, just it's a great solution for that reason alone. I think in that, it gives you it's almost like a leg up on the property ladder from your parents who might be supporting you with deposit, but also you still might have that need to get the mortgage. So, you can utilize their income as well, as long as it's affordable. And I guess the really good point there is, if you did that with most lenders, most banks will say, right, if you're coming on a mortgage, we need whoever's going to be on a mortgage has to be on the deeds of the property as well. So a lot, I'd say most will say, right, we don't do joint borrower sole proprietor, we do joint mortgage, joint owner. And that's the only option in it, really, is it's kind of, if you're going to be on the mortgage, if your parents are going to be on the mortgage, they have to be on the deeds as well. It's a condition of most lenders. So where this really does work well is exactly that, where actually you're getting the pro of having them on the mortgage and getting that bigger mortgage. But like you said, there's tax implications, stamp duty is often a lot higher, especially if your parent owns a property already. So, and you're right, it protects their first-time buyer status as a first-time buyer, if you are a first-time buyer, to actually benefit from the lower stamp duty or even the incentive. And like you said, keep sole ownership of the property so that there's no kind of complications down the road. I like the idea of it being a short-term solution as well. I completely agree. I think it isn't there for your parent to support you for 25 years or longer. The idea is, like you said, in a few years' time, hopefully mortgage balance comes down, your income goes up. You might be single, you might then enter into a relationship. You can then use that partners if you decide to. You can then have that partner come on. That's another income to take off your mum or dad or both. And then you're on your own, which is great. But you don't then have to make any changes to the deeds, do you? Because they're the part that the parent isn't on the deeds anyway. So sorry, were you going to say something?
Yeah, I was just going to jump into like what the qualifying criteria was, in terms of, because I think probably people that are listening. So the qualifying criteria is it is a not normal mortgage from that perspective. As I mentioned, it's you repay your mortgage back on a monthly basis. There's no sort of extra deposit need from your parents or anything like that. There's no minimum income as such, but again, it's all looked at on affordability. The mortgage has to be affordable from both points, from both sides. So they do probably look at it with a magnifying glass from that perspective at both sort of incomes and outgoings. I guess one probably, I really back this scheme, by the way. I'm a big believer in the scheme. I think it's fantastic. I think if it's used in the right way, it's a really good scheme. One of the downsides and one of the obstacles is maybe, if your parents are in their 60s, maybe going into the 70s, or even earlier, to be honest, and you're looking for a mortgage term of 20, 30, 35 years, and lenders will look at the bigger picture. Although this is a short-term solution, they will look at the big picture because they need to make sure you can pay the mortgage back over the period. So the biggest challenge is, how are the banks going to lend to mum and dad when they're in their 90s or in their 80s and 90s? How are we going to? So that is one of the obstacles. But fortunately, there are some good building societies out there that will go up to sort of age 95 if you're in receipt of a pension income. So there is quite a few banks out there that can help with that. But that is probably one of the biggest obstacles with the scheme is more around parents' age.
Yeah, 100%. And we've both seen that where, great, I've got a parent who wants to come onto the mortgage, and you're kind of thinking, I hope they're young, I hope they're under 50. And obviously most of the time they're not under 50. No. And then you kind of are in the realms of, okay, well, we can't go for a 35-year term. It's all about maximizing affordability, like we said. And one of the best ways of maximizing affordability is going for a long term. So if it was a standard joint mortgage for a couple in their 25, let's say, you could take them all the way up to a 40-year term on the mortgage. That helps you get the maximum mortgage affordability. But lenders, like you said, lenders will go with the maximum age criteria on the eldest applicant. So if the eldest applicant is 55 and they lend up to age 70, but they have to repay it before they're 70, you've got a 14-year term. Is that right? 14-year term maximum. So all of a sudden, you've gone from 35 years on affordability to 14 years. Two things: reduces your affordability, so it works against you because lenders are going, monthly payments are higher, we're not going to lend you as much as you want. And the second thing is the monthly payments are higher. So like you said, the affordability of the actual payments becomes really, really difficult. And in reality, a lot of people I speak to kind of say, I'm still going to pay this. I'm not going to rely on my mum and dad to actually pay it. I want to pay it. The good thing is, from a bank's perspective, and the parent obviously understands, they are jointly liable for the mortgage. So actually, it is based on all their incomes, how you decide to pay it or who pays it. As long as it gets paid on time and no one's in the, in a difficult position, then that's kind of up to you. But you're absolutely right. Are there any other challenges, do you think, with joint borrower software?
I think the one is parents need to seek independent legal advice as well. So there is, an extra bit of, I probably want to reiterate the fact that this is a mortgage where you will need, it's not a DIY mortgage. This is not something you do it yourself, and go online. And this is something that you, in my opinion, you really need to get advice on, because there are things like the tax implications, the mortgage lenders that are lend specifically to this scheme and mortgage. And also now we're talking about legal advice as well. So, parents will need to seek independent legal advice. And more is just to cover the point that they are responsible for a mortgage, but the property isn't there in their name. They're taking on a large amount of borrowing, but the full ownership is in parents' name. One thing I probably want to add, I don't know if I did add, is it most of the time it has to be a relation to you. So if someone's supporting you, and I know people might be listening thinking, my friend so and so might be able to help. It's very difficult to get someone, particularly banks, to lend to someone who you might just be friends with. It's more specifically on close relations. Parents are probably the most common one. Grandparents, potentially brother and sister, may even go down that line. But when we're talking sort of a friend, or it becomes a real challenge then. So it has to be someone of a close relation.
Fantastic, brilliant. I think we've covered it. I feel like I'm looking at the clock and I'm thinking, have we covered it? I don't know. Is there anything else that you wanted? I think you summed up exactly how it works, who it's for, the benefits of it, the pros and the risks of it. Is there anything else that you would point out?
No. I think anyone listening to this that's considering, looking at getting onto the property ladder and then considering this, again, probably reiterate the advice part. Having your parents on board is a big commitment on both sides, and there are quite a few obstacles along the way. But I back the scheme personally. Really, the mortgage itself, I think it's fantastic. I think if it's used in the right way, it can be a huge benefit to first-time buyers, and it just may be able to plug that gap if you're reaching that 200,000 property and you can only get to 160, 170. It might just be able to push you over that line. So I think it's good for those sort of opportunities, in my opinion.
Great.
Yeah.
I think that's great. And I think the only thing I'm just thinking, is there anything else that we could probably add? It's not really relevant for first time buyers, but if anyone's listening to this, you can also flip it. So, I've helped clients before who have needed to help their parents, for example, come to the end of an interest only mortgage. They don't know how they're going to pay it. They don't want to sell the property. They haven't got enough equity in there to do that and buy somewhere, and they don't have enough income to remortgage. I've helped clients before who are adult children. That sounds a bit weird, but they're adults trying to help their older parents with remortgaging. So I've helped couples or son and daughter go onto a mortgage to help their parents so that they become liable for their mortgage because they're on an interest only mortgage. It stops them from needing to sell the property, but it also means that they kind of they help in taking over the mortgage debt. They become liable for that debt. There might be some tax benefits to doing that. I don't know. But there are some options there. But just another kind of, you can be very creative with this joint borrower sole proprietor. But a really good way, most common way is exactly what you said there, is helping first time buyers.
You're right. It can be flipped and you can help parents with it. Yeah, that's absolutely right. Caveat it with seek tax advice, and we should put that on the bottom.
And mortgage.
And mortgage advice. Yeah, absolutely. No,
Brilliant.
Bro, good episode. Cool. I think, shall we wrap up?
Let's do it.
Thank you for joining us for another episode of Let's Talk Property. We hope you found the discussion on the UK property market informative and helpful. If you have any questions or topics you'd like us to cover in future episodes, feel free to send us a message. Don't forget to subscribe to the show and follow us on social media for updates. Until next time, we'll see you in the property market.
So confident that every time it's perfect, but
yeah.
I don't know.